Okay, hello everyone. Welcome to this video in which we're going to talk about collateralized debt obligations, or CDOs as they are commonly referred to. These are going to be yet another type of asset-backed security. Fortunately, the list of different asset-backed securities that we're discussing is coming to a close. There will be future videos where we focus more on mortgage-backed securities, but don't worry, nothing more than that to come. Well, these are going to be debt securities once again, which are secured or backed by something. In this case, they are debt securities backed by, well, your book says by one or more debt obligations, essentially. So you know that typically we would use mortgage loans to create ABSs. We, in the previous video, talked about credit card receivables being another debt obligation. We talked about solar ABSs. Here we're going to focus, in a moment you'll see on what, on something known as CLOs. These are collateralized loan obligations. Okay, CLOs, CLO, collateralized loan obligations, and these are going to be backed by, well, once again, it's going to be backed by a loan, but in this case, leveraged bank loans. Now, what does that mean? Leveraged bank loans are typically, when you say leveraged loans, that can mean a number of things, but leveraged bank loans are typically identified as loans made by banks to businesses where those businesses already have a significant amount of debt on their balance sheet, so they're quite indebted. And the idea of making leveraged bank loans is they are more risky than loans made to businesses with lower levels of debt. That's basically it. So very often, or quite often, such leveraged bank loans will be in the cover pool for, collateral pool, not the cover pool, that's covered bonds, in the collateral pool, used to create what we call collateralized loan obligations. And in fact, CLOs are going to be our primary type, the prevailing type of collateralized debt obligation. There are others that you just need to know about, sort of kind of briefly. There's something called the CBO or CBOs. These are, once again, collateralized but bond obligations, where the collateral will come in the form of either corporate bonds, so trading securities, or emerging market debt, emerging market bonds. So once again, somewhat riskier than your typical sort of sovereign debt stuff. You'll also see, we'll talk about this, we'll mention it, you'll see that we can also create synthetic CDOs. Those will be created with the use of credit derivatives, most notably credit derivative swaps. Okay, more on that to come. Let me just tell you that this shift towards CLOs being the prevailing type of CDO, where we use as backing leveraged bank loans, that's something that largely occurred post 2008, because prior to 2008 we had a lot of focus and emphasis on structures where the collateral were various types of mortgage loans, including commercial mortgage loans, for example, CMBSs, in the run-up to the 2008 financial crisis, that was very much something noticeable. Okay, well, aside from this, this general discussion, the focus of the sort of rest of the video is going to be CLOs. So from now on, we're focusing on the collateralized loan obligations, where the cover is indeed comes in the form of leveraged bank loans. And let me tell you about some of the sort of basic underlying features of these types of structures. As we've said on plenty of occasions before, with the exception of covered bonds, all the other ABS structures result in the collateral being removed from the balance sheet of the bank. So collateral is removed from the bank's balance sheet. These are bank loans that we're using as collateral here, as backing. So they get removed because the risk is removed. The bank loans are sold to an external special purpose entity. So that has the obvious, or I guess already talked about, effects of not requiring funding on the other side of the balance sheet, but also reducing the capital requirements. Right, what you'll also find here, typically you'll get the tranching, so you'll have different classes of these CLOs broken down into different bond classes. Okay, and another very important feature, not necessarily featuring in all the other ones, although it was something that we saw with credit card receivables used as collateral, the collateral pool is not static. It's dynamic, it changes. Collateral pool is not static, it's subject to change. And what you'll find is that there is a special sort of additional player in this, or actor in this whole structure, known as the collateral manager. The collateral manager is there to potentially make acquisitions, purchases, but also sales, buys and sells debt obligations. So in this case it would be bank loans for the CDO, so into and out of the CLO collateral pool, because the collateral manager has the job of making sure that the collateral is sufficient to meet obligations towards investors who purchased various classes of these tranched out bonds. They'll be actively managing the collateral pool, and later on we'll make a comment on this, as the collateral manager being a bit like an active bond fund, fixed income fund manager. Right, they need to make sure those cash flows are sufficient. Talking of cash flows, well, where do the cash flows come from? Cash flows to investors come from, okay, and here are the various sources. Well, they come from interest payments. At the end of the day, we've got the collateral assets are generating interest. They are, after all, loans, so this gets transferred. So they do generate interest because they are loans, and those get used to pay investors their cash flows. Right. The second source is what your book calls, very sort of enigmatically, I think, the maturing of collateral assets. However, that is a very roundabout way, I think, of saying principal repayments, because as loans mature, they get repaid. principal repayments. That's the idea. And of course, because you've got the collateral manager actively managing the portfolio, the collateral pool, selling, buying and selling, well, another source of cash flows, inflows in this case, is the sale of collateral assets, of course, by the collateral manager. Right, and something that really I think is important from an to appreciate is that the whole job of the collateral manager, and I did mention already that they're a bit like the an active fund manager in a bond fund, is on the one hand you've got your collateral assets, your collateral pool, the assets into which the money has gone. That's being sort of managed by the collateral manager, and this is supposed to generate a return into the CLO structure, CDO structure, right? And from this, you're supposed to make payments to investors. Obviously, the investors who purchase the different tranches or classes of bonds. Now, as we said before, because everything here is tranched out, you'll have senior tranches, you'll have mezzanine tranches, you'll have junior or subordinated tranches. So let's just write a few of those words down. You've got senior, you've got your mezzanine, which are this kind of in between, and or behind this you've got the bondholders, the people who, or the institutions who acquired these securities. And the thing is, the senior and mezzanine, sort of everything that's between the top and the very bottom, that's the mezzanine, these investors typically receive fixed returns, in the sense of getting a fixed coupon, something that we promise them. However, at the bottom, you can have more than one in between tranche, of course, and over here you'll have the most junior tranche, which is often known as the equity tranche. And we did mention that name before when we were discussing subordination. So the equity tranche is the most junior of them all. And the thing is, over here you're not going to get a fixed return. That return is going to be very much variable, and I don't mean variable in the sense you'll get an interest rate which is a function of the market reference rate. No, you'll get a return which is a function of how much is residually left after we've paid all the people above you. So these returns are very much more equity-like returns. It's a bit like having an equity stake. Essentially, the return that we get from the collateral pool, the idea is we want to make this higher than the cost of funding, the funding that we've received from the senior and mezzanine bondholders, okay? And any excess that is left kind of accrues or goes to the equity or equity tranche holders. So I really am making a big deal of this point because I think it's really important from an exam point of view. Your book very wisely says that the idea behind this whole setup, its substance, we may say, the substance of this of a CLO is such that it is at heart a leveraged transaction. And even though everybody here is in fact a bondholder, I mean even the people who hold the equity tranche, they are bondholders, they hold fixed income securities, but it's got very much features of equity, as in having the claim on the residual flows or the residual cash flows from the structure. So the holders of the equity tranche, and I do appreciate that this may be confusing because we are talking about bonds after all, but I'm saying it's equity. Well, it's at heart, or in essence, equity. you may think of them as use borrowed money, and they borrow from the mezzanine tranche holders and the senior tranche holders to generate a return, hopefully, which is higher than the funding cost. That's what we mean. And if this goes right, if the assets perform well enough, if the return is big enough to pay these people off what they were promised as their fixed return, then yes, so that's going to be the sort of the cost of funding to these higher up tranches. Then there will still be something left over in excess to go to the junior tranche holders, the equity tranche holders. Okay, so that was more or less the essence of the transaction. Let's now talk about variance, the role of the collateral manager, and so forth and so on. In terms of variance, you just need to know potentially a few terms. The most common type of CLO you are likely to encounter is known as the cash flow CLO. Cash flow CLOs, of course, CLO standing for collateralized loan obligation. So this is the most common of them. Okay, what's going on here? Well, the idea is quite simple. It's the most intuitive of the structures. Cash flows from interest and principal payments are distributed among the tranches. Simply, very straightforward and logical. Hence, that's the most common one of these. The second type is something known as the market value CLOs, and this is by no means as common as the first one. So I'm just going to mention it, but don't really worry about it too much. I don't think we'll get examined at all, if at all, in a very sort of detailed, in a very tough theoretical question, because this is something most people will not even get to in their studies. This is where the value accruing means going to the individual tranches, depends on the market value of the portfolio. Okay, no more details needed. It's a more complicated structure, as you can probably tell. And then just one more: the synthetic CLO. This is where, instead of necessarily buying underlying securities, buying underlying loans into the portfolio, you actually replicate the necessary exposure via credit derivatives, CDSs. So that's why it's synthetic, because you don't use the real thing. The collateral pool is created synthetically, and you'll see that come up quite a lot every time we mention derivatives, synthetically via credit default swaps, a type of credit derivative which you can learn about in the derivatives section of the curriculum and our videos as well. Okay, so those are the variants. Don't bother about these too much. I think what is kind of also quite important is to talk about the collateral manager, because the collateral manager is something very specific, is somebody very specific for this type of ABS structure. You won't necessarily see them elsewhere. Remember, I've mentioned this there already. Their job is to ensures the ability to make interest and principal payments, okay, to the investor. Make interest and principal payments to investors. And something you may get tested on is that there are going to be certain tests which sort of underpin the work of the collateral manager. So I'm going to say over here, must meet performance tests and collateral tests or collateral limits. And these are not necessarily tests on the for the collateral manager, rather than the collateral which they manage, right? Okay, and the thing is, we'll talk about these rules in just a moment, but please appreciate that in case of these tests or limits being exceeded, in case of a failure to satisfy these rules, what you'll find is a provision in the agreements for a pay of principal. So principal payoff is triggered, and what will happen is when those tests are not satisfied, let's say, the money will immediately go to the senior classes in the structure. Senior classes are paid off kind of as quickly as possible when the tests are not met, and this has the effect of deleveraging the whole structure. So let me write down this: deleverages the CLO structure. So, the idea is, if it turns out that our collateral is not good enough, it doesn't perform well enough, etc., etc., you use the money to pay off your highest level investors, and you therefore deleverage because you've paid off some of the debt. That's the idea. However, when I say you've paid off some of the debt, I'm kind of thinking from the point of view of the equity tranche who's at the bottom. You've deleveraged the structure, the CLO. You've paid off the cheapest funding source, the senior bond investors. Okay, and you'll see a little bit more about these tests in just a moment. Now, the collateral portfolio, this is also quite important. It is typically not finalized. Its composition is not finalized kind of immediately. Is not finalized until the transaction closes. So, although most of the loans that go into the pool are purchased before the transaction close, so when the bonds are issued, we kind of already have most of the loans in the pool. There is a later so-called ramp up period where additional assets are still being added, additional loans are still added. Okay, that's the point of the ramp up period. So even though the bonds have in going into the various classes have already been issued, we're still adding to the portfolio. And as we said before, once the whole thing is absolutely up and running, the manager will typically may replace certain loans in the pool obviously providing that the loans that they want to introduce do meet certain criteria, right? And of course, later still, those underlying loans mature, they get paid off, hopefully. And then naturally the manager uses those cash flows to pay off the tranches, to return money back to the investors, to pay off the tranches, of course, in the relevant order of payment. And okay, one thing to note here is that typically recourse, the ability to go back and claim funds, is limited to the collateral pool. If investors are not satisfied with the amount of money they get from the structure, i.e. it's too low because of, I don't know, higher than expected defaults, then you typically cannot go back to the original issuer, that's the bank, and claim money from them. Your recourse is typically limited to the collateral pool. That's the whole idea of creating an SPV, and the bank therefore being able to remove the assets from their balance sheet because they are no longer at risk from, let's say, credit or default risk. Okay, as with, just a few additional comments before we finish this video. As with pretty much every one of the previous structures that we discussed, where we had tranching, subordination, you are likely to encounter that classic waterfall structure that I've talked about before, whereby the tranching goes from senior all the way down to junior or equity, the senior tranche. Here, what you may expect is that it will get a very high rating, like AAA, which is the top rating you can get from a rating agency. And that means it's associated with the lowest risk. But also, it will generate the lowest yield. The coupon paid on this is going to be relatively low because it's a very safe, at the end of the day, instrument. Then you're going to have your classic mezzanine tranches, so those in-between types of tranches, which of course face higher risk, or the investors face higher risk over here. But obviously lower rating as well, and as a consequence, higher yields are to be expected as compensation for the higher level of risk. And then you've got your most junior of all tranches, which is the equity tranche. And as I've been saying, the investors in this tranche really can be seen as more like equity investors, because even though they hold a bond, in reality they're using the cheap funding from the other guys or the other investors higher above to generate a return for themselves. So this is the most junior of the tranches. It's the most risky, and typically it's not rated. Yeah, there's no reason to rate it. You kind of know that you're buying the risky stuff. It will have no fixed coupon, as I've mentioned before. What these people receive, or the equity tranche holders, this tranche receives the excess cash flows. Anything that's left once the other tranches have been paid off, simply. Okay, and just a few, words about the sort of the different tests that you may get with collateral that I mentioned before, where failure to meet these tests may trigger some kind of action, a speedy repayment of the higher tranches. So these tests are known under different names. Your book kind of mentions, coverage tests. Well, a coverage test is more about the idea of over-collateralization. It's the over-collateralization test. Once again, this is a really long word. Over-collateralization. Yes, I spelled it correctly. Test. This is, we've talked about this so many times. This is about ensuring that the principal value, of the collateral backing the pool, so that's the underlying loans, should be higher than the face value, principal value. Face value, as we typically say with bonds, of the bonds issued or notes issued under the CLO. Okay. Now, the idea is, if this ratio of this, proportion, if the ratio of one to the other declines below a set amount, below a trigger point, then there is action. Cash is going to be immediately diverted to the senior bondholders, diverted to senior bondholders to pay them off as quickly as possible. Obviously from the more junior ones. So this will accelerate the repayment, and this is pretty much of the senior bondholders. This is pretty much what I wrote somewhere up here when I said, well, yeah, if in case of failure to meet a certain test, principal payoffs triggered, senior classes are paid off as quickly as possible, leaving the others still unpaid. So whatever money we've got, we just we diverted away from the others towards the senior bondholders. Now, typically, what you'll also find is that each tranche will have its own over-collateralization ratio target. Tranche has its own, over-collateralization ratio target. Okay. And once again, the idea is, if that target is breached in some way, if it's not met, the cash flows will be redirected to repay what is currently the most senior of tranche. It may be the case that some of the originally most senior tranches have already been paid off. So whatever is the most senior tranche at the moment will start to get repaid very quickly, or indeed the collateral manager may use cash flows to purchase additional loans for the collateral pool just to secure it more properly. So that's not necessarily just a very simple thing. That there are some choices to be made here. So that's over collateralization. Some other tests that you may come across here, once again, these are tests concerning the quality of the collateral, concerning certain limits as well. It's all to do with protecting investors in the CLO from losses, right? So you may want to see how well diversified the collateral pool is. So diversification in the underlying pool of loans, because you want to limit the possibility of too much, well, in some way, yes, limit the concentration of too much risk in a single industry, which, with assets being highly correlated to one another. Or you may want to limit the amount of exposure that we've got to, let's say, non-senior loans in the pool, which are themselves subordinated, or you come last in terms of repayments, or you want to make sure there are limits imposed on lending or on having loans in the pool that come from the same, not even the same industry, but the same borrower. So you want to ensure diversity of borrowers, and this is pretty much what I talked about before, that you will have certain limits imposed on collateral in terms of it being not too concentrated on a single industry, on a single borrower, etc., or a certain type of lower quality obligation. And let me just emphasize at the very end, this is going to be the very end, it's absolutely critical to think here about the role of, well, it's not critical to think. What is critical is the role played by the collateral manager. Critical role, collateral manager. Let me write down what I previously expressed in words. In this case, the collateral manager acts as an active bond portfolio, pretty much an active bond portfolio manager. That's their job. Selecting, replacing, buying new things, selling stuff that they don't think is going to perform that well, or maybe it's a good opportunity to sell and replace with something else. Active management, collateral manager. We didn't have that in the previous types. Here it's that role really gets emphasized.